Welcome in this video. If ZBCN is listed on Coinbase, what will happen to the price? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand. In the analysis of price movements, especially bullish order blocks are among the most closely watched structures in technical analysis because they represent areas where the market's buyers have accumulated most strongly. A bullish order block located just below the price actually indicates areas where large players, such as institutional investors or high-volume buyers, have previously been active. Therefore, when the price approaches this level, it often sets the stage for renewed buying interest in the market. The presence of a bullish order block just below the price shows us that, in the event of downward pressure, the strongest defense line could form at this level. This structure also functions as a support zone because the previous aggressive moves by buyers have created a memory that can push the price higher, and market participants are likely to exhibit the same reaction when this area is reached again. The price approaching the bullish order block is also psychologically important for investors because this area is often perceived as a safe buying point. Large funds and traders who operate in the market usually monitor the same levels, leading to a significant liquidity accumulation in this region. When the price enters this liquidity pool, an upward reaction generally occurs. The critical point here is that a bullish order block represents not just a support level, but also strong buying pressure. Therefore, when the price reaches this level, it signals an area where the bulls are likely to step back in. Especially when the price touches this block and reacts with strong bullish candles, market participants' confidence increases, which can lead short-term buyers to open positions as well. From a technical analysis perspective, bullish order blocks are a powerful tool in determining the structure of price. If the price reaches a bullish order block and gains support from it, this can not just be a temporary bounce, but also a movement that sustains the continuation of the trend. The rationale behind bullish order blocks is that the market has previously absorbed sellers strongly. In other words, sellers were once neutralized and buyers established dominance. When the price returns to the same point, the same dynamics tend to activate again, allowing buyers to regain control. This phenomenon is commonly observed in bullish markets, with the price drawing strength from bullish order blocks during pullbacks to reach new highs. There is also a deeper psychological background to this structure. A bullish order block just below the price is seen as an opportunity by many traders because they often place buy orders in anticipation of the price reaching this level. Therefore, when the price arrives at this zone, numerous purchases can occur at once and the price reacts upward quickly. As a result, a bullish order block becomes not only a technical level, but also a strong support line in the collective market mindset. Repeated buying at this level by investors helps sustain upward price movements. To determine whether the movement generated as the price approaches the bullish order block could signal the start of a long-term trend, volume analysis in this area is also crucial. If the price reaches this zone and high-volume buying is observed, it confirms the strength of the bullish order block. In cases where volume remains low, the area might only produce short-term bounce reactions and may not be sufficient for a long-term trend reversal. Nevertheless, because bullish order blocks often carry the footprints of large players, the probability of upward movement from these zones is always high. The position of the bullish order block just below the price also serves as a strategic safety net. When the price reaches this zone, investors can determine stop-loss levels more clearly, which provides a major risk management advantage. When an investor buys believing the price will be supported by the bullish order block, they can quickly close their position if the price drops below this area. This allows losses to remain limited while potential gains remain substantial. This logic has led many professional traders to place bullish order blocks as key points in their trading strategies. Additionally, bullish order blocks have continuity. If the price receives support from this zone once, it is highly likely to see the same support again when it returns. This creates a stair-step effect on the price chart. Each pullback finds support in these blocks, bouncing the price upward and forming new highs. This makes the market's uptrend healthier and more sustainable. For long-term investors, these zones are among the strongest signals confirming trend continuation. Receiving support from the bullish order block also increases confidence in the market. When the price reacts upward from this area, it demonstrates that the bulls remain in control. This sense of security mobilizes not only existing investors, but also new investors looking to enter the market. Thus, the market can sustain upward momentum more strongly. As a result, support from a bullish order block can signal not only a short-term rise, but also the potential start of a long-term uptrend. Considering all these details, a bullish order block just below the price is a critical turning point for the market. If the price gains support from this area, the bull's strength is reaffirmed, and upward expectations in the market increase further. Conversely, if the price breaks this block, the bull's control may weaken. However, the current structure indicates a high likelihood that the price will find support when it reaches this block, as the general market logic shows that strong blocks are not easily broken. Therefore, the presence of a bullish order block just below the price clearly indicates that the market's upward potential remains strong, and that the price can initiate upward movement from this level.
The MACD indicator is one of the most widely used momentum indicators in technical analysis, and is highly effective in determining the direction, strength, and potential reversal points of price movements. MACD is based on the concept of moving average convergence-divergence and essentially measures the difference between two moving averages. The crossovers of these averages and the interaction of the MACD line with the signal line provide critical clues about future price movements. In particular, when a bullish crossover occurs, meaning the MACD line crosses above the signal line from below, it generally indicates that upward momentum has begun in the market and the potential for the price to move higher has increased. This crossover is considered a strong buy signal for investors and traders because it shows that the market's momentum is shifting and upward pressure is strengthening. The bullish crossover signal of the MACD provides important insights into short and medium-term trends of price movements. When the price has been moving sideways for a while or stabilizes after a downtrend and the MACD performs a bullish crossover, this movement often signals the beginning of a trend reversal. The most critical aspect investors should watch at this point is confirmation of the crossover. If, after the crossover, the MACD line remains above the signal line, it indicates that the price's upward momentum is sustainable and selling pressure has not yet dominated. In such cases, the upward movement of the price can be stronger and more lasting. The effect observed on the price when a bullish MACD crossover occurs is also psychologically significant for investors. Traders and market participants generally increase their buy positions when they see this signal because technical indicators suggest a high probability of the price moving upward. This collective buying behavior causes the price to react quickly upward. Short-term traders especially monitor MACD crossovers to identify points where the price is likely to gain momentum and position themselves accordingly. This is a classic example of a chain reaction in technical analysis. The signal from an indicator triggers market participants' actions, which in turn supports the price upward. The bullish crossover signal of the MACD also confirms the strength and direction of the existing trend. For instance, if the price is in a downtrend and the MACD crosses upward, this indicates that the downtrend is slowing and a potential trend reversal may occur. At this stage, the price's movements are critical for traders because the bullish crossover shows that downward momentum is weakening and buyers are beginning to regain control of the market. This is a strong indication that the price may make short-term upward moves, and investors can use this information to optimize their positions. From a technical analysis perspective, the bullish crossover of the MACD is also important for understanding where the price stands within a larger trend. If the price has been moving sideways for an extended period and the MACD crosses upward, this indicates that the price is breaking out from a previous consolidation phase and signals the start of a new upward trend. Thus, the MACD is not only a short-term momentum indicator, but also an effective tool for predicting the direction of medium and long-term trends. Therefore, investors follow MACD bullish crossovers not only as short-term buy signals, but also to anticipate trend changes in the market. When analyzing how the price will react to a bullish MACD crossover, the time frame of the signal and the price's current position are very important. For example, if the price is above a strong support level and the MACD crosses upward, this indicates that buyers are strengthening and the price could move to higher levels. Conversely, if the price is near resistance levels, the MACD crossover suggests that the price will test these resistances and could start a rally if broken. Therefore, the bullish crossover of the MACD is critical for estimating the price's potential movement and its speed.
The cup and handle formation is a commonly encountered and classic chart pattern in technical analysis used to predict the future direction of price movements. As the name suggests, this formation refers to the price rounding off like a cup to form a bottom and then creating a handle before rising again. The cup area generally forms over a long period as the price slowly declines and then consolidates at a stable level. During this process, investors observe the price's bottom levels and begin evaluating buying opportunities. The depth of the cup indicates how much the price has declined and the potential recovery volume. Therefore, the more pronounced and clear the depth, the higher the potential for upward price movement. Once the cup and handle formation is complete and the price begins to rise from the handle's endpoint, an increase roughly equal to the depth of the cup is generally expected. This is considered a classic target by technical analysts and is used to predict the potential ceiling level of the price. One of the most critical elements of the cup and handle formation is the price slowly forming a base in the cup area and then rising again in the handle area. The cup portion is a consolidation period where investors prepare to buy and market volume is relatively low. During this period, the price remaining stable allows investors to enter positions with confidence. The formation of the handle occurs as the price gains upward momentum following its previous horizontal or slightly fluctuating movement. At this stage, the price movement generally accelerates and attracts investors' attention. Especially in cases with high volume buying and increased market participation, the likelihood of the price rising by the depth of the cup is strengthened. The completion of the formation and the subsequent rise can be accelerated by various triggering factors. For example, a coin being listed on a major exchange like Coinbase can dramatically increase investor interest and market volume. Such a listing can speed up the achievement of the technical targets predicted by the cup and handle formation and support the price rising by the depth of the cup. In other words, while the formation itself indicates the price's upward potential, fundamental factors like an exchange listing act as triggers that determine the speed and magnitude of this movement. This combination is considered a strong buy signal for investors, both technically and psychologically. The cup and handle formation generally provides more reliable signals in medium and long-term trends. The price slowly forming a base in the cup area indicates that the trend is strong and sustainable. If the formation occurs over a short period with low volume, the reliability of the signal decreases. However, a well-defined and deep cup followed by a handle indicates a high probability that the price will reach the targeted levels. Therefore, when performing technical analysis, it is important to evaluate the cup and handle formation not only by its shape, but also in conjunction with trading volume, market participation, and other technical indicators. When the formation is complete, the price rising by the depth of the cup serves as a critical reference point for investors to realize profits. Investors can adjust their positions and plan risk management with this target in mind. Additionally, the cup and handle formation is often used as a signal confirming trend continuation or trend reversal. In other words, it provides a strong forecast that the price will continue its previous uptrend or initiate a new rally. Major fundamental catalysts, such as a Coinbase listing, further strengthen this forecast technically and increase the likelihood of the price rising by the depth of the cup. In summary, the cup and handle formation is a structure where the price first forms a bottom and consolidates, then accelerates upward from the handle area. When the formation is complete, the price is expected to rise by the depth of the cup, and this technical target is taken into account by market participants. A major catalyst, such as a Coinbase listing, can trigger this movement and accelerate the achievement of the technical targets predicted by the formation. Therefore, when the cup and handle formation and fundamental triggers come together, the probability of upward price movement is very high, and the potential increase is as significant as the depth of the cup.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.